I come to the realization that there's a lot of people that are trying to get into the stock market. They're trying to get into the investing game. They don't know where to start. This vlog is about how to pick stocks and how to actually get into the stock market. And that's what we're going to talk about today. There's a lot of people that have saved a ton of money in their retirement, which is great, but they're trying to take that next step and actually go out and start actively investing instead of just passively investing into their 401k or their IRA. And that's what this is about. The first step is to realize there is no such thing as a free lunch. And what I mean by that is you're not going to be able to go out there and make 200, 500, 1,000% gain off of something really incredible consistently or repeatedly, like Bitcoin or such as a pot stock. That stuff just isn't realistic. And if you get lured into that, I feel really bad for you because you're going to lose all your money. Kind of like the time that I invested in Binance. I've invested in 5 different cryptocurrencies, and I lost 90% in about, a few months. Learned my lesson then, not going to follow that trend again. The most important thing to think about when you get into investing in active stock picking is start conservatively. I know that sounds like the exact opposite of what you want to do. You want to pick Ford Motor Company, or you want to pick Amazon, or you want to pick this or that. What you want to do is think about, how can I beat what I have going for me right now? And so if you invested in your minimum investment, let's just say that your 401k, it's making 6% a year. What could you do reliably to beat 6%? Well, I can think of a few things off the top of my head. It's not going to be cash, because that depreciates over time at 2% to 3% a year because of inflation. It's not going to be in treasury bills, because that has around a 2.5% interest rate over time and is risk-free. But let's ratchet up the risk a little bit. Let's go to corporate bonds. Corporate bonds pay well. All right, so I'm going to go ahead and buy a Tesla bond, not a Tesla stock, Tesla bond. And wait a second, wow, why does a Tesla bond pay 8%? That sounds really good per annum. That's way better than my 401k, a whole 2% gain. Now let's throw some money at that. Wait a second, risk level is way higher. Tesla bonds aren't AAA or triple B. They're junk bonds. All right, so this is where the risk factor comes in. You have to ask yourself, is it worth buying a junk bond in order to get the 8%? And you're probably saying to yourself, Tesla's going to be around for a few years, so I guess I'll buy those bonds. Or will they be around? If you go straight for the extreme, for example, if you go straight for the pot stocks, it's still a federally Schedule 1 drug. It's the same as heroin or something like that. So that's really super high risk. You can't buy cannabis that's recreational or medicinal in states with anything except cash or debit. They don't accept credit card yet, because banks rarely even want to do business with a federally illegal type of product. And so when you go to invest in those types of companies, there's literally thousands of companies starting up. That risk level is just off the charts. And so I don't even think about that. If you're going to start to invest, think of large cap, medium cap companies. I work at a company that's actually mid cap, and mid cap companies are great to invest in, but not all in a lump sum. So maybe you want to invest in a segment like mid-market tech in the cloud. So you say Salesforce, and I want to invest in Splunk, I want to invest in Workday, and I want to invest in Zendesk and Zora and New Relic and all these other types of companies like that. And then suddenly you have a nice portfolio. And why did I pick mid-market tech companies? It's because I know about mid-market tech companies, and I have confidence that those are going to grow over time. And so you might even consider buying an index fund or an ETF that encapsulates that whole market. Now, the first active investment that you might want to take is even a little bit more passive, is just invest in the S&P 500. Given the long time horizon of 40 years, the S&P 500 has proven that it can pay out 10.2% over time consistently, and that's pretty much better than anything in the world. If you want to start picking individual stocks, focus on the things that you know. That's basically what Warren Buffett says. Invest in what you know. So if you worked in the car industry, the auto industry for a long time, invest in auto companies that you know are going to be good long term. Avoid the companies, or short the companies that you know are going to fail long term. I think Tesla is going to do very poorly long term for my own personal reasons. So I was recommending or considering shorting Tesla about 6 to 12 months ago, and I wasn't wrong. Tesla's been going down the tubes, and it's because of the company fundamentals are wrong. If you have an inside scoop into an industry, then that's where you should hang your hat, because that's where you're going to make the most money. Now I want to get into some of the nuances here about investing. Let's just say you want to put a bunch of money into a specific stock. Now, maybe that's a mid-market stock. Let's say that company is Workday, and they're trading well, they're trending up high. First thing to do, compare that stock's performance against the Dow Jones Industrial Average and the S&P 500. Hey, maybe it went up 100% over the last 18 months, but guess what? The benchmarks went up as well. So maybe Workday isn't so good after all. Again, with the other companies as well. Are we looking at macro or micro investing? I'm probably guessing that you want to do this long term. But if you're looking for day trading or short-term investments, right now is a really risky time to invest, because we're on the verge of an economic collapse. So if you were trying to get in the market, make some quick cash, and trade around, market's super volatile right now. Something to keep your eye on is the VIX. It's the fear index. As the VIX goes as the VIX goes down, the fear index goes down. That's the scariest time, meaning that at any moment it could snap and go the other way. But if the VIX is climbing and climbing and climbing, now we already know we've gone off the cliff. So keep your eye on the VIX. As far as picking individual stocks, I see this rookie mistake happen very often, where you've got this company, that company, this company, and they go up and down day by day, and they do this. You're investing in the fundamentals. Look at the 10K. Listen to the company reports. Do your research, and think about investing from a broad perspective. Think a bigger picture. So if you're going to invest in a mining company, for example, look up what are all the top mining companies and use that as a benchmark. Again, there's some pretty great ETFs out there. At the end of the day, if you're trying to get into active investing, I would really focus on what you know well. I focus all my active investing in tech stocks exclusively. And anything outside of tech stocks, I'm either in treasury bills or I'm in the S&P 500 SPY ETF. All right, I hope that you found this useful. If you did, hit the subscribe button below. And if you really want to hear more, hit the notification button as well. Thanks a lot. See you next time.